It sounds almost too good to be true, doesn't it? Consistently beating the stock market without needing like an army of analysts or a fancy Bloomberg terminal, or maybe even a crystal ball. For many of us, I think navigating the world of investing feels a bit like trying to read a map in the dark. We hear snippets, maybe get a hot tip, or just sort of throw our money at something and, well, hope for the best. Well, today, we're aiming to switch on the lights. We're taking a deep dive into Joel Greenblatt's The Little Book That Beats the Market. It's a text that genuinely aims to simplify investing for, really, any determined individual. Greenblatt, who is a successful hedge fund manager and also a professor at Columbia Business School, he released this book back in 2005 and then updated it in 2010. His explicit goal really was to give you, the everyday investor, a systematic, rules-based approach to finding great companies at bargain prices. So our mission today is to unpack his now famous magic formula. What is it? Why does it hold such power? And precisely how can you apply it to become a more disciplined and potentially a far more successful investor?
You're ready for some surprising clarity, I think, and maybe more than a few aha moments about how, well, profoundly simple smart investing can actually be.
Yeah, and what's truly fascinating here, I think, beyond just the promise of beating the market, is how Greenblatt's work really tries to democratize investing. He's challenging this widely held belief that, this kind of success is only for an elite few with insider knowledge or some secret algorithms. His whole premise is that a robust, clear set of principles can absolutely level the playing field for anyone willing to learn and, maybe more importantly, to stick with it.
Sticking with it. That's often the hardest part, isn't it? Because for most of us, investing just feels utterly overwhelming. We're bombarded by headlines, gurus predicting the next crash or the next boom, and that endless parade of hot stocks that, a friend of a friend swears by. So we try to time the market, or we jump into whatever's trending, or maybe we just pick a broad mutual fund and cross our fingers. And the reality is, more often than not, those strategies just lead to disappointment.
It's a really pervasive problem, and it's not just for individual investors either. Greenblatt's work, and frankly lots of other sources, clearly show that even a significant chunk of highly paid Wall Street professionals struggle. They struggle to consistently outperform broad market benchmarks like the S&P 500 year after year. The core issue, like you touched upon, is often emotional investing. It's that classic destructive cycle. Buying high when the market feels exciting and everyone else is piling in, only to panic and sell low when things get volatile or start to drop. And this isn't just a novice mistake. It's a really deeply ingrained human tendency. It's a behavioral challenge that trips up even the most seasoned experts.
Right. So if chasing the latest fad and letting our emotions run the show is, well, a path to underperformance, and even the pros aren't immune, what is the foundation of a more sensible, more effective approach? How do we cut through all that noise and get back to what actually matters?
Exactly. And that's where Greenblatt, interestingly, doesn't try to reinvent the wheel. He takes us straight back to the foundational wisdom. He builds firmly on the shoulders of giants. He reminds us that the best investment strategies are often rooted in surprisingly simple yet profoundly powerful truths.
Yes, and that's key, isn't it? He's not just presenting some completely new, unproven theory out of nowhere. He's drawing deep inspiration from legendary investors like Benjamin Graham, often called the father of value investing, and of course his most famous disciple, Warren Buffett. Okay, so let's unpack this core idea that underpins everything. Value investing. What does it truly mean to invest with this kind of mindset? And how does Greenblatt interpret it for us?
Well, at its absolute heart, value investing is simple, yet kind of radical in today's market. A stock is not just a fluctuating number on a screen or some symbol to trade back and forth. It represents actual ownership in a real business with real assets, real employees, real profits. The core insight is to approach the market not as a casino, at a place for speculation or quick flips, but as a mechanism to buy fractional ownership of these businesses at a discount to what they're truly worth. This creates what Graham famously called a margin of safety. And if we connect this to the bigger picture, it means that in the long run, stock prices do tend to follow the actual performance and the underlying profitability of the business. Sure, short-term hype, speculation, market sentiment that can create wild swings, but eventually the market tends to recognize intrinsic value. You're essentially looking for situations where the market is mispricing a company, offering it for less than its true economic value.
So it's really about being a business owner, like a patient partner, rather than a gambler trying to predict the next roll of the dice. You're looking at the fundamental underlying asset. But the million-dollar question for us as everyday investors is, how do we actually figure out which businesses are both fundamentally good and currently cheap? That's where the rubber meets the road, right?
Precisely. And that's where Greenblatt's genius really comes in. He developed the magic formula specifically to simplify that historically complex process. He boils it down to just two extraordinarily powerful metrics. It's a systematic answer to your million-dollar question.
2 metrics. Seriously, after all the talk of complex financial models and endless ratios, that's genuinely surprising. Okay, here's where it gets really interesting. Greenblatt distills all that complexity into just 2 simple yet incredibly powerful measures for his magic formula. Tell us about them.
That's right, just two. He cuts through all the noise and focuses on what truly matters for someone thinking like a business owner. The first metric is earnings yield, and this is his measure of cheapness. It tells you how much profit a company generates relative to its overall price. Think of it like this. If you were buying the entire business, how much annual profit would you get for the total price you'd have to pay? You're essentially looking for a bargain. Now, the formula he uses is EBIT. That's earnings before interest and taxes divided by enterprise value. And just to be clear for listeners who follow this stuff, Greenblatt chooses EBIT over, say, net income because it focuses on the company's core operating profitability before you get into the distortions of taxes or how it's financed. And crucially, he uses enterprise value instead of just market capitalization. The stock price times shares outstanding. Why? Well, because enterprise value gives you a more holistic view of a company's total worth. It includes not just the market value of its shares, but also its debt, and then it subtracts any cash the company has. It's essentially the total cost if you were to buy the entire business lock, stock, and barrel. It reflects the true economic value more accurately than just its stock price alone. So a high earnings yield means you're getting a lot of operating profit for the full price you're paying. That signals a relatively cheap stock.
Okay, that distinction with enterprise value is really important. It makes intuitive sense. If you're buying a business, you're not just buying the equity, you're also taking on its debt. Okay, so that's the cheapness side of the equation. What's the other half of Greenblatt's magic?
The second metric is return on capital, ROC, and this is his robust measure of quality. This shows how efficiently a company uses its capital, the money invested in the business, to generate profits. It's all about finding businesses that are truly good at making money with the resources they've already deployed. You want companies that are capital efficient, consistently churning out strong returns from their investments. Now, the formula for return on capital is EBIT. Again, that same measure of operating profit divided by the sum of net working capital and net fixed assets. And just to be super clear again, when Greenblatt talks about capital here, he's referring to the actual operational assets required to run the business day to day. Net working capital, think current assets minus current liabilities, represents the readily available cash, inventory, short-term funding needed for operations. Net fixed assets are the long-term physical things like property, plant, equipment. So together they represent the actual, tangible capital a business directly employs in its operations. This makes ROC a very focused measure of how efficiently a company uses its core resources to generate operating profit. A high ROC indicates a highly efficient, high-quality business.
Got it. So if I'm putting this together, you're looking for companies that are both a bargain, that high earnings yield, and really good at making money with what they have, that high return on capital. It simplifies things tremendously, doesn't it? It feels like this specific combination, finding both cheap and good, is what gives it that magic. Does focusing on both metrics specifically filter out common investment traps that people often fall into?
That's exactly where the power lies, absolutely. See, most investors tend to focus on either cheapness or quality, but rarely both systematically. They might buy a deeply cheap stock only to find out later it's cheap for a very good reason. Maybe it's a declining business or has serious operational problems. That's what people call a value trap. Or, conversely, they might buy a fantastic, high-quality growing company, but they pay such an exorbitant price that all its future growth is already baked in. There's just no room left for the stock price to appreciate further. That's kind of a growth trap. Greenblatt's dual filter, combining both high earnings yield and high return on capital, helps you avoid both of those pitfalls. It ensures you're not just buying a bad business cheaply, nor are you overpaying for a good one. You're systematically hunting for that elusive combination. A high-quality business offered at a bargain price. It's a beautifully elegant way to capture the essence of value investing without needing complex, subjective analysis.
Okay. We know the 2 powerful ingredients now, cheapness and quality. We've seen why they matter individually and, more importantly, together. Now, how do we actually put this into practice? What does magic formula strategy actually look like for an investor like you or me day to day? How do we apply this systematically?
Well, the strategy, remarkably, is almost mechanical. And that's a key part of its brilliance because it helps remove emotion from the equation. So first, you'd effectively rank all the eligible companies based purely on their earnings yield, from highest yield to lowest. So the cheapest companies get the top ranks. Second, you rank all those same companies again, but this time based on their return on capital, also from highest ROC to lowest. So the most efficient, highest quality companies rank highest here. Third, you combine these two rankings. You're looking for companies that score well on both measures. So for example, if a company is ranked, say, 10th cheapest and 5th most efficient, its combined rank might be 15. The lower the combined rank, the better the candidate. Fourth, you then invest in a diversified portfolio of about 20 to 30 of these top-ranked companies. Greenblatt really emphasizes diversification here because, look, not every single pick will be a winner, but the overall strategy applied consistently has shown to be effective over time. Fifth, you hold these investments for about a year. And crucially, step 6, you rebalance your portfolio by repeating the entire process. You sell the companies that no longer rank high, or maybe those you've held for about a year, and you buy the new top-ranked companies that appear on your refresh list. And seventh, and this is arguably the most critical step, you repeat this consistently, year after year, regardless of what the market is doing. This isn't a one-time stock pick. It's a long-term, systematic process.
It sounds almost too simple, doesn't it? No complex charts, no trying to predict market movements, no endless news analysis. Just a systematic, disciplined approach that focuses purely on fundamental business value, using those two powerful metrics. It really takes the guesswork out of it.
That's precisely Greenblatt's point. It removes the need for complex, often emotional, and frankly, typically underperforming decision-making. You're letting the numbers guide you to solid businesses at good prices, and then you're letting time do the heavy lifting.
So what does this all mean for us then? If it's so elegantly simple and is historically shown to be so effective, why isn't everyone doing it? Why does this strategy seem to work so well, and yet what makes it so challenging for people to actually stick with it through thick and thin?
Yeah, this really gets at the heart of it, doesn't it? And the answer lies in this fascinating interplay between the strategy's intelligent design and, frankly, our stubborn human psychology. Firstly, as we discussed, the formula works because it uniquely and systematically combines value and quality. By seeking out businesses that are both fundamentally strong and currently undervalued by the market, it creates that powerful edge. It helps identify those Ferraris at the price of a Ford, so to speak. This dual screening helps filter out both the duds, the value traps, and the overpriced darlings, the growth traps, which most individual investors and even many professionals often miss when they focus on only one aspect. But the second part, and perhaps the more crucial reason why people struggle to stick with it, comes down to a significant behavioral hurdle. The magic formula can and will underperform the overall market in the short term, and we're talking sometimes for months or even potentially a couple of years. Now, imagine diligently following the strategy, watching your portfolio lag behind the general market, while maybe your friends are boasting about their latest hot tech stock picks. That brief underperformance, coupled with our natural impatience, our innate desire for immediate gratification, and the constant media noise that causes many investors to abandon the strategy prematurely. They jump ship just when the strategy might be about to shine again, convinced somehow that it's broken.
Yeah, it's the classic investor dilemma, isn't it? We crave the results of long-term thinking, but our short-term emotions, fueled by the daily market roller coaster, constantly threaten to derail us. So patience isn't just a virtue here. It sounds like it's an absolute requirement. This strategy isn't really about brilliance or making lucky guesses. It's fundamentally about having the profound discipline to stick with it through those inevitable ups and downs, trusting the underlying logic.
Absolutely. Greenblatt is crystal clear on this point. The source material emphasizes that while short-term underperformance is pretty much a given, over longer periods, typically 5 to 10 years or more, the strategy has historically demonstrated its ability to beat the market significantly. It doesn't reward quick wins or chasing the latest trend. It rewards relentless consistency and the patience to let the underlying business performance and the market's eventual recognition of that value do its work over time. It's truly a marathon, not a sprint, and it demands more psychological fortitude, perhaps, than intellectual brilliance.
Okay, so if you wrap up our deep dive today, what are the most crucial, actionable takeaways for you, the listener, looking to maybe apply this in your own investing journey? How can we really internalize and put this magic formula, or at least its principles, to work effectively?
Well, I think Greenblatt's ultimate lesson is that discipline, far more than brilliance, is the most powerful asset an investor can possess. You, the ordinary investor, you don't necessarily need complex analytical skills or a team of researchers or a crystal ball. What you do need is this steadfast commitment to follow a few clear rules consistently. It's critical to consciously avoid emotional trading and that futile attempt to time the market, which, as we've seen, are common pitfalls for almost everyone. You also have to recognize and importantly accept that short-term results can be disappointing. There will be periods where your portfolio lags the broader market, that's just part of the process, but your focus must remain squarely on the long-term compounding of returns. The core message is clear and I think incredibly empowering. By systematically investing in high-quality companies at bargain prices, maybe using something like the magic formula, everyday investors truly can potentially outperform the vast majority of professionals over time. It's really about leveraging a systematic approach to value investing and just letting it work its magic over the long haul.
Yeah, it really does strip away a lot of the intimidation, doesn't it? It simplifies value investing, removes those tricky emotions from decision-making, and gives you a legitimate pathway to potentially beat the market over the long term. It's fundamentally about buying good businesses for less than they're worth and then having the profound patience to let that intrinsic value and hopefully those returns compound. So today we've explored Joel Greenblatt's magic formula, a systematic, two-metric approach to finding high-quality companies at bargain prices. It really proves that disciplined, long-term thinking can indeed outperform short-term speculation and emotional trading. So here's maybe a provocative thought for you to consider as we finish up. What if the biggest secret to success, not just in investing, but maybe in many areas of life, isn't about uncovering some hidden complex truth at all? What if it's simply about the consistent, patient application of a few clear, fundamental principles that are right there in front of us? How often do we let immediate results, or maybe just the constant noise of the world, distract us from a sound, long-term strategy? And what might we achieve if we simply manage to stick to the plan year after year?